Welcome to the ET Money Show, and let's kickstart our first discussion, wherein retirement is often considered synonymous with old age. But in the recent years, this term has seen a new meaning, with many young people opting for early retirement. Now, the new generation of retirees are quitting the workforce and are setting for a retired life in their early 50s. So if you are someone who is planning an early retirement, onto the ET Money Show today, we will help you to chalk out investing strategies to achieve that early retirement dream of yours. Let's bring on board Gautam Kalia, who is the financial planner, and he'll guide us through what all measures or thinking that you should be having to have and achieve this goal. Hi, very good evening, Gautam, and thank you so much for joining us today on ET Now. Very happy new year to you. But before we talk about the investing strategies for early retirement, Gautam, could you start by telling us what exactly do you mean by early retirement, and what is the trend that you are witnessing in this regard, especially with the new Gen Z and millennials population? What are their thinking on these front?
Sure. Thank you, and Happy New Year to you as well, and to all your viewers. Just wanted to talk about a little bit about the FIRE movement, which is Financial Independence Retire Early. And this is something that we are seeing becoming more and more popular with the Gen Zs and the millennials. I would say the younger millennials. Basically, what we see is that people earlier were obviously looking at 60 as the retirement age. Some are who love working, they're looking at probably even increasing their retirement, delaying their retirement, while many others are looking to make and save money as quickly as possible so that they can actually get on to the next career, which is their real self-actualization, what they really want to do. And while they call it early retirement, what they really want to do is something which is like follow their passion, which will not be able to generate that kind of income that they'll need to support their living expenses. And that's why they need to probably take up a more conventional vocation to be able to raise that kind of income. So the FIRE movement is something which is now, I would say, about 10-15 years old. But in India, we're seeing only recently in the last 2-3 years that is gaining traction. I think thanks to the pandemic, a lot of people started questioning their own existence and trying to, take a more elevated philosophical view approach towards life. I think with the greater upward mobility in the Indian middle class, there's much more financial safety and security. So a lot of the young generation feel comfortable exploring alternative vocations rather than the typical engineer, doctor, professional setup that someone like me had when I was growing up. So that's what we're seeing in terms of a trend. And now, if you look at retire early, there are people who are trying to retire as early as their mid 30s. So it's not just about retiring in by the time you're 50 anymore. It's also about people looking to retire in their 40s and their 30s. So that's really a new trend that we are seeing. And obviously, when you're trying to do something like this, then there are different ways that you have to approach this. So you got something called a lean FIRE and you got something called a fat FIRE. There are about 5-6 different types of FIRE, but I'll just cover these two. A lean FIRE is where you've saved just enough to be able to support your basic expenses, but you will need to do another job or something on the side. Maybe it's part-time or freelance, which will also additionally support your expenses. While a fat FIRE is where you are able to save so much that you are able to live off quite comfortably. You can expand your needs and wants as you wish, because you've kind of saved up a large corpus that is also generating enough income for you to live off, partly off. So these are the two ways to go about it, depending on your current income. How minimalist are you ready, willing to live? How much are you willing to save today to be able to master the effects of compounding in early compounding, so that you're able to take advantage of that later on in life.
Well, absolutely take your point, Gautam, and like you highlighted that this trend is getting even bigger, not just in 50s, people are considering to retire maybe in their mid-30s, but Gautam, early retirement would also mean that losing out on your primary source of income. So how should one individual decide on the amount of the money or maybe the budget that they need to have in order to retire early, at what point in time you feel that you must be talking to a lot of investors out there, a lot of people who are still opting to retire early? How do they get to that point where they are very clear on their decision of retiring early?
Right. So before I answer your question, the first disclaimer that I give any of my clients who want to retire early is that something that you really want to do? Because you can go on holiday for a couple of weeks or a month and tell yourself this is the life I want to live. But after 3 months or 6 months, that life can get boring really quickly. And then you start questioning your self-worth. What are you contributing to society? What are you doing with your life? So those kind of questions then start coming up. That's the negative side of retiring early, which people often don't check. And if you look at a lot of studies done, people who retire early tend to die faster. So that is another thing that people don't look at, is something that one should consider seriously. So obviously a second career is obvious. From a personal finance perspective, when you're talking purely number terms, then there's a simple rule of thumb which is called the 4% rule, or the rule of 25, which is essentially you take your annual expenses. Let's say your annual expenses are 10 lakhs, and you multiply that by 25. So that brings up to 2.5 crores. So 2.5 crores is the corpus that you need to be able to live off 30 years by just withdrawing 4% of that every year. So you withdraw 10 lakhs from that every year, and you'll be able to live till the corpus ends at after 30 years. So that's really the rule. Is based on a few assumptions, like you'll put 50% in debt and 50% in equity. The inflation rate will be about 3%, while your portfolio performance will be around 8%. So if you tweak those numbers a little bit, then the 4% can become 5% or 3%, depending on those numbers. But typically the rule of thumb is that if you just take your annual expenses, multiply that by 25, and that's your target corpus that you need to be able to retire off of. So Fat Fire typically, instead of doing 25 times, it does 50 times, and Lean Fire takes it, instead of 25 times, 15 times. So those are the variations to the fire philosophy that people are looking at.
Understand, and a very interesting point that you made there, that people who tend to retire early tend to die even faster. So maybe one of the probable red flags that you highlighted there. But Gautam, we'll talk about how inflation eats your saving and the goal that you decide after your early retirement stage. But before coming to somebody who is looking to retire maybe in mid-30s, like you have highlighted, the new trend is suggesting. What do you think that at which point in time, as per their age, they need to start planning for their early retirement? And also on the asset class front, what is the most likely preferred bet? Is that equities, which generally tends to promise you better returns in comparison to some of the safer asset classes? How is the probable asset allocation looks like to your investors?
Yeah, so you start off, the earliest age to start off planning for retiring, early retirement, is as early as possible. So really, if you're straight out of college, or straight out of post graduation, and that's when you start working, you're starting your own business, and you want to retire early, that's how quickly you need to be to start to think about early retirement. And the faster you are able to start the saving and investing, the faster you will be able to reach your target, and maybe even reach a higher target if you are able to delay your ambition of retiring early. So my suggestion to everyone would be that if you're in your early 20s, that's the best time to start thinking about retiring early, because that's when you end up spending a lot of money that you can probably save. And if you're in your 30s and 40s, you look back and say, okay, there were many opportunities where I could have saved money. You start getting serious about retiring only in your 30s. By then it becomes a little bit too late to retire early, as in you probably need you don't have that kind of headroom and runway in terms of saving. So that's why, one, you start to look at saving as early as possible. Second, obviously, in terms of asset classes, historically speaking, across the board, equity is by far the best performing asset class. It comes with a lot of risk, volatility, but it's also the best performing asset class, and you need high returns to be able to generate enough corpus to retire early. So you're basically trying to fast track everything, and that's why you need to play it more aggressively. So you need to invest mostly in equity. Obviously, when you are doing this, you can't be careless about your money, and you have to have risk control and risk mitigants in place. So you can't just start off one day and start doing F&O trading or very aggressive direct trading strategies that can end up you could end up losing your investment value. So it's about finding the right risk reward combination. So I typically recommend to a lot of my investors to look at mutual funds, because they have a very robust risk management processes in place at the mutual fund level. So you might as well go in for something like that, leave it to the professionals. But when you're investing in mutual funds, then go all equity, because you are looking at a 30-40 year time horizon. So you can make the most of that and kind of average out the volatility.
Understand. Totally take your point. But Gautam, inflation could also eat into the savings of the people who are looking to retire early. Now, in such a scenario, Gautam, how should someone looking to retire early have an inflation-proof portfolio, maybe, and ensure that their savings are inflation-proof? What's your piece of advice on that?
Yes. So inflation, most people don't know this or don't think about this, but inflation is also compounding. The 5-6% headline inflation that we see, that expense is growing year on year. So you really need to ensure that whatever portfolio you have invested in either debt, equity, gold, real estate, that as a whole is growing faster than inflation. If it's not growing even 1 or 2% faster than inflation, then you are basically looking at your wealth eroding over the long term. Because anytime there is a spike in inflation, you are actually becoming poorer in real terms, and this is something that people don't really think about seriously. So you have all these terms like gentrification of the neighborhood, and you hear all these things, but really that's part of it is also about inflation and quality of life improvements associated with that. And one point which is not directly, I would say, related to inflation, but related directly to retiring early, is that your best earning years are probably in your 40s and 50s, where you've gained enough experience, you've kind of reached a certain stage where you're able to take advantage of that experience, and you're getting rewarded more handsomely. So you're kind of missing out on those years' income because you retired early. So there's a big opportunity loss for you to kind of create intergenerational wealth, for those 20 years that you don't work. And that's also something that people should keep in mind when they do plan to retire early.
But Gautam, life is actually full of uncertainties. Now, events like COVID-19 pandemic have reminded us how unforeseen events could actually derail your investments and plans. For someone who is planning to retire early, how can they ensure that a future event does not impact their retirement saving?
Right. So future events attack the most volatile asset class first. So equity is obviously the most volatile. But if you have a 30-40 year kind of investment horizon, then that volatility smooths over. So while COVID in the 6 months before and after COVID was extremely volatile for equity, if you look at it from the perspective of a 10-year period, that volatility kind of, you'll see it as a blip if you view it in a graphical form. So one suggestion I would do, having said that, people still react differently to volatility. And if you're the type of person who'll end up taking a rash decision, let's say exiting your equity position at the bottom of the market, and then you'll be waiting for an entry and you won't find that entry. If you find yourself displaying that kind of behavior, then you're probably better off adding more and more debt allocation to your portfolio. And you have different products in the form of debt allocation. You have pension plans available. While I was waiting in for the show, you had the LSE pension plus add playing. So you got so many pension plans also available, which are essentially, I would say, life insurance plus some form of debt. Or you could just look at debt mutual funds. You could invest in gold. You could have some real estate in your portfolio, assets that are giving you rental income. So you could kind of diversify your portfolio if it's large enough to a multi-asset approach. As you get closer to retirement, so that way you are reducing the overall volatility of your portfolio. Obviously, that will come with its own reduced expected return on the portfolio, and that's something that you'll have to bake into your calculations when you do that.
Totally take your point. But Gautam, my last question to you is if you can just help us understand the tax implications for someone who is looking to retire early. What should be the ideal planning for tax efficient withdrawals in retirement? Your views on that.
Okay, so if you have, let's say, rental income of a property, then that's treated as your, income for the year, and you're paying the income tax on it. It could go up to 30% plus. But if you have, let's say, assets in equity and you sell some shares or some mutual fund units, that is long-term capital gains tax, which is only about 10%. So those are two, opposite ends. If you have something in debt, then you have again the long-term capital gains and the short-term. While pension plans, for example, some of those pension plans have no tax on the income as well. So you have that tax benefit accorded to you by the government, and there are some high value pension plan options available where you can even get a pension of, let's say, 5-10 lakhs a month if you want, and that's treated as tax free currently. So you have those options available in the market currently, and I think uh, tax you have to be careful of. As long as it's not treated as income for the year, then you have a more tax efficient approach to managing your retirement.
Okay, Gautam, thank you so much for joining us today on ET Now. It was a pleasure having you onto the channel, helping our viewers understand how can they plan to retire early. Thank you so much.